Hi, my name is Jonathan Matthews. I'm based in London and I'm a fund manager. Most of my time is spent doing the work and the research for the portfolio at the moment, so it's been a very busy 9 months. I like to kind of stay fit, so I enjoy cycling, running, walking, and up until COVID hit, I did enjoy traveling as well, but I haven't been doing so much of that in the past 9 months. For my undergraduate degree, I studied classics at Oxford, and then after that, I did a master's in classical linguistics. So I was attracted by the excitement of markets and the fast-moving nature of it, and also the opportunity to work with numbers, which is something I really enjoyed, even though I'm not a total maths whiz. In September 2006, I joined a large US asset management firm as an equity analyst for 7 years. I picked up my CFA qualification along the way. After that, I joined an Australian investment bank in London. I did equity sales for 4.5 years. And then in January of this year, I joined E15 as the Chief Investment Officer. I came across algo trading in the course of the job, and I was also thinking of ways to to invest my own capital that EPAT enabled me to develop further. EPAT seemed to be the most complete program out there, and specifically it also had modules on Python. EPAT has a really impressive roster of lecturers and teachers, some of whom are practitioners or traders in their own right, so that gave it some extra credibility in my eyes. There was a lot of material covered in a very short time. We could reach out to the lecturers at any point to get any help we needed, which is something I made use of, and so found very helpful. Even though I worked in finance for over 11 years at that point, I still got to learn about strategies, particularly on the options side, that I'd never even heard of. Also, there were some ideas that I already had some grasp of, which were developed much further. I would encourage anyone who already has a lot of experience in finance to give it a go, because you'd be surprised at actually how much more there is to learn about systematic trading. EPAT was a very diverse course. It lifted the lid on lots of different elements of systematic trading. What I really liked about EPAT was the coursework element. Really kind of forces you to think about the material you learned in a previous week. Specifically, there was a lot of focus on building strategies in Excel and also in Python. I think for me, all of the coursework we did through that 6 months really kind of opened my eyes to all the different kind of paths you can take within systematic trading, all the different kind of strategies within both equities and options. I found the options particularly interesting. I would definitely say find a mentor and don't try and figure everything out by yourself. A lot of people think that all they need to do is find a strategy and everything will kind of take care of itself, this kind of whole get rich quick attitude, and that sometimes leads you down the path of trying to find the perfect strategy. And obviously there's lots of stuff on the internet that you can buy for varying amounts of money. What I would say is don't fall for that trap, stay well away from that. The only other thing I would say is there's no real substitute for hard work. There's no substitute for market experience. Just get used to the fact that you're going to have to put in the time and things won't happen overnight.
Welcome once again, everyone. It was a pleasure to have you all yesterday, and we are thoroughly humbled to have received such a wonderful feedback. My name is Pawan, and I'll be your host today. I'm sure that you all are excited about today's session, wherein we are going to cover the nitty-gritty of data analysis and strategy making, which is the heart and soul of algorithmic trading. Hence, it's a must to pay close attention to what is going to be covered today. And at the end of the session, we would also answer your queries just like yesterday. So make sure you stick around until the end. Just in case if you drop off midway, please use the YouTube broadcast link that we have shared with you on an email and chat. As we are at peak capacity, there is a chance that you might not be able to join back in. I would now like to run a quick poll to understand what pool of audience is attending today. So I would request each one of you to select the option that describes you the best. So I'll just run the poll now. Here we go. All right, so about 75 to 80% of the people have already voted. So Ashutosh, a quick note, we have majority of the people who are traders by themselves, right? We have 8%, 8 to 10% of people who are programmers. We have about 15% of people who are data analysts. So these are the major pool of people which we have today attending for the session. So you might want to keep that in mind, right? And I would love now to pass the stage to today's speaker, Mr. Ashutosh Dave, and I hope you all have a wonderful learning experience. Over to you, Ashutosh.
All right. Thank you for the breakup, Pawan. So it sounds like a great breakup. So we will keep that in mind. If I may please share my screen.
Yes, we can
All
see your
right,
screen
guys.
now.
Okay. All right, great. So welcome everyone. I hope you guys had a great time yesterday. You learned a lot of new things. And today we are going to take it one step ahead, right? So yesterday, what we looked was the bigger picture, right? So today we are going to discuss finer details. Just a customary disclaimer before we begin. So all investment and trading in financial markets involve risk, right? So trading strategies or related information mentioned in this presentation is for informational purposes only, right? A little bit about myself. So my name is Ashutosh Dave. I'm Senior Associate Content and Research at QuantInsti. In my previous avatar, I used to be a derivatives trader in London. I specialized in commodities and fixed income. Uh, After joining QuantInsti, I have written a book which is called A Rough and Ready Guide to Algorithmic Trading with my colleague Vivek Krishnamurthy. So today the idea is to basically, a quick recap from yesterday, right? So we will do a quick recap, followed by we will learn about strategy development workflow, right? So we'll go into a little bit more detail, right? So how do we, create a trading strategy from scratch, right? Um, so after that, we will actually develop a sample strategy, and then we will see how we can make it better. And finally, we will have the questions and answers round in which, it will be an open mic. You can ask your questions. So yeah, let's jump right in. So a quick recap from yesterday. If you guys recall, we went through the steps, right, in algorithmic trading, right? So the whole thing starts with an idea, right? So you should have some sort of hypothesis to create a strategy around, right? And then we convert it into a sort of rules based on which we can buy and sell assets, right? Then we make use of data, right? So that's here. So we actually backtest our strategy on historical data before we paper trade it for a while, right? And if everything is fine, then we actually take it live, right? So this is the whole workflow for like developing and implementing a quant trading strategy. But today, primarily, we are going to focus on the first three, right? From idea generation to converting into code and then backtesting it on historical data, right? So first thing is the idea, right? So what can be the sources of idea? So basically, a lot of quant strategies are based on academic research, right? Or it is based on people's experience in financial market, or they are some variation of a well-known strategy, right? It can even be a hunch, right? Or if it can even be a claim that you would want to test, right? And you derive something useful out of it, right? So in quant research part, what we do is that we are working with data, right? So we can actually derive rules out of the data itself, right? Even if we have little experience in the market, right? We can do a lot of trial and error, right? So a lot of trial error goes into research. We try to, formulate hypotheses. We try to test them on the data, and we take forward only what has promise, right? Now the next thing is alpha seeking, right? So what is alpha, right? So as most of you are traders, you would be aware that alpha is the excess return that you get over and above any uh, benchmark, right? And say, for example, S&P 500 gave 10% return, and your strategy gave 15% return, right? So that excess 5% would be the alpha of your strategy, right? Now, in this phase, we ask several questions, right? So what we try to answer here is the why part, okay? And why part is the one which makes the most difference, right? Because if we trade without a reason, then it is pretty much gambling, right? So we need to ask, why is this strategy likely to make money, right? What is the reason that is going to generate those excess returns, right? What sort of edge are we trying to exploit in the market, right? Is there a particular pattern in the market that can be exploited on consistent basis, right? So we are trying to identify, those factors which can give us a potentially profitable strategy, right? Now, in the quant world, we know that we make use of data, right? So like we saw yesterday, these are the different types of data that we can use actually to build our strategies. On the more basic level is the market data, right? So most traders look at price, volume, open interest, volatility, right? All these factors. Then we can also incorporate fundamental information, right? So company specific information such as earnings, right? Future prospects, or debt, how much debt the company has, etc. Right? You can look at the macro picture. How's the economy looking? Right? What's the GDP numbers, inflation, etc. Right? Then we have got the technical indicators, right? So technical indicators is the favorite among traders. So people use all the things, right, from moving averages, RSI, Bollinger Band, right, and all other technical indicators, right? And technical indicators are basically a transformation on the market data, right? They are a specific way of looking at the market data. That is basically your price, volume, open interest, delivery volume, etc. Right? And then we have got the alternative data part, right? And a lot of people are now interested in how we can, exploit, say, Twitter sentiments. Okay, people like, for example, Elon Musk, or I don't know, Donald Trump tweeting, and it moves the market. So how can we exploit those things, right? So that is the realm where we use ML techniques, right? Such as natural language processing, etc. Right? We can also exploit satellite data, right? So basically, what we are trying to get at is the core reason that is going to make us money, right? So that is how we can look for, how we can look to generate alpha from all this data, right? Next thing is the universe selection, right? So now this part is the one which answers what, right? So okay, so we want exposure to a certain asset class, right? For example, we want exposure to a particular stock, right? So should we just go and buy it in the cash market, or should we buy a futures contract, or should we buy, an option, right? And the choice here would actually depend upon two factors. First is cash management, right? So for example, if you go and buy a stock in a cash market, right, it has you don't need to put in margin money with your broker, right? You just go and whatever money you have, you buy stock out of it, correct? Whereas for futures and options, they are leveraged in some sense. So what happens is that you need to put margin money with your broker, and then your risk also increases, right? So this is the question of universe selection, right? So which stocks, right, or which instruments are we going to trade in, right? And that is the what part, like what are we actually going to trade, right? Moving on, then we saw that what we try to derive are the entry and exit rules, right, which are nothing but logical conditions that will lead to a buy or a sell, right? What will trigger our buy or sell, right? And while designing these conditions, we keep in mind a few things. Two of them are the timing and frequency of trade, right? So how often we will enter and exit, right? What will be the rebalancing frequency, etc. And the second thing is how much we will trade, right, on getting the signal, right? So that is a question of position sizing, right? So we will keep that in mind, right, for deriving these rules. And then for quant trading or algo trading, what we need to do is that we need to code the rules, right? And for this, we can use a language like Python. You can actually use MATLAB, C++, etc. if you code in those languages. But Python is one of the easier languages, right? So it's more like human speak. So it's easy to pick up. So we will use Python, right? And this is actually true for low frequency and medium frequency trading. If you are trying HFT, which I know very few of us will be doing, then the preferred language of choice is C++, right? But for all research purposes, Python is an excellent choice, right? Now, if you do not know coding, right? If you do not like to code for some reason, right? Then we have something called as visual coding, right, which is offered by Blue Shift. So where you just you have some logical blocks that you can arrange as just like a puzzle sort of, and you can actually create a strategy out of it, which is very, very exciting feature. But we will actually go through that thing tomorrow, right, on day 3. Today we will work with Python, right? Moving on, then we backtest the strategy. So as the name suggests, backtest. So we go actually back in time, right? We are dealing with past data, right? We fetch historical data from from various sources. You can get this kind of data. Least of all, your broker will provide you. Your broker can provide you this sort of data if you subscribe for it, basically. You can buy it from exchange, you can buy it from data vendors, right? Such as global data feeds, etc. Right? Or you can use one of the free APIs. Now the thing with free APIs is that of course you won't get that level of information as you would get with, say, a paid data plan, but they are really, really good, like surprisingly good, at least for EOD data, end of day data. And we are going to see one of them used today, which is the Yahoo Finance API, right? So once we have the data, we can run the strategy on historical data, right? We can see then how it would have performed historically, right? So that is the process of backtesting. And once we have the results, we can analyze it in several ways. We can look at the risk matrix, we can look at profitability matrix. So we can analyze it from different angles, right? So that is the process of backtesting. Okay. Now moving on, let's just jump right in and develop a sample trading strategy, right? So what is our aim over here? So this is just a simple sample strategy. And it will involve a little bit of Python code. If you are new to Python, don't worry. I will try to make intuitive sense for you what the code means, etc. But please try to get the concept, right? What we are trying to do. Okay. So the very first thing is the aim. What is our aim? Right. So suppose our aim is to design a long only trading / investment strategy in Indian NBFC sector. So NBFC is basically non-banking, financial companies which give, insurance and other services, but are not banks, right? And we have got two objectives. So the first objective is that it should perform much better compared to a passive buy and hold strategy. So what is buy and hold strategy? It is a passive strategy where you just buy the stock and leave it. It is the most basic kind of investment people do, right? So they buy an asset and they leave it. They hope it's gonna go up in value someday, right? So that is your buy and hold. And that will serve as like a benchmark today for us, right? We will compare the performance of our strategy with buy and hold case, right? And goal number 2 is to save us from big downside fluctuations, right? So basically, we don't want to see our account going down suddenly by 40%, 30%, or some such number, right? Which happened incidentally just last year when the coronavirus, took off in the world in the month of March. There was a huge crash, and people's portfolios, equity portfolios, tanked around 30%, right? So we want to save ourselves from such scenarios, right? Even though the market recovered later, but you know that a lot of people would have panicked and got out at that point, right? So we try to avoid such a situation. Okay. Now comes the idea generation. So how do we go about it, right? So basically, I'm using two simple, sources. So one is my own experience in the market, and secondly, very basic knowledge of fundamental and technical analysis, right? So all of us who have traded before, and as Pawan mentioned, a lot of you are already trading. You would have, that little bit of knowledge that is required for today's session. If not, we will actually discuss that, right? So that is where the idea is going to come from, right? Next thing is the universe, right? So we will only stick to large cap stocks, for example, because of course one of our goals is to keep our downside limited, right? Large cap is less risky compared to say mid cap and small cap. Okay. Secondly, it is also highly liquid, so we have less slippage, right? So when we try to execute an order at a price, it's likely that we will get it. Okay. Right. So now comes the alpha part. Okay. See, before when we discussed alpha, right? So there are several kinds of alphas that we discussed, right? So we can actually, get some edge from using fundamental information. We can get some edge using technical information, right? Or alternative information for that matter. But we can actually combine several alphas to get some advantage, right? And that is what we are going to do today. So out of these 4, we are going to use the price, right? We are going to use little bit of fundamental information about the companies, and we are going to use one of the more popular indicators, which is called the RSI, right? And I'm sure most of you have heard about RSI, and it is one of the most popular indicators up there with say Bollinger Bands, etc. So we will try to use basically 3 out of 4 things here. And first alpha that we are trying to get is from selecting a security based on strong fundamentals, right? So this is basically putting some filters, right, in terms of security selection. Okay. Now there are so many ratios, right? Different ratios. People look at P by E ratios, people look at price by book ratio, etc., etc. They look at earnings, they look at return on equity, return on capital employed, etc. Just to keep things simple, what we are going to do is that we are going to get some financial data about some large cap stocks in the NBFC sector. That is our target universe, right? Okay, so let me just execute the command. All right, so we have the data, right? Now what I have done here is that I had the data in an Excel file, right? So we just use a simple function called read Excel that is part of the pandas library. Okay, but more importantly, let's look here, the data that we have got. So we have got data for actually, 4 companies. So say these are the 4 contenders that we are looking at, correct? We have got their P by E ratios, we have got their market capitalizations, and we have got their year-on-year quarter profit growth, and this is for the latest quarter, right? Now we can devise different filters, right? So just in case, suppose I'm looking for a company which has got profit growth, quarterly profit growth year-on-year of say greater than 30%, and is P by E ratio is less than 40. So what does P by E ratio indicate? It indicates, if it's basically, are you getting an attractive valuation or not? So we want this number to be less, right? Profit growth, everyone wants a high profit growth. Yeah, we want to invest in a growing company, right? So this structure in which I have got data is basically referred to as data frame, right, in Python. Now this is this will remind you of maybe say Excel sheets, those of you work with Excel, right? But this is just like Excel on steroids, right? So basically this is a really powerful package in Python which is called pandas, right? And we can write some conditions. Okay, so we can put 2 filters. So let's look at filter 1, right? So filter 1 says that we only want those companies where the year-on-year profit growth for the latest quarter is greater than 30%, right? Secondly, we want a company where the P by E is less than 40, right? Now this thing you can optimize with your experience, whatever you think. You can consider different ratios, you can consider volatility compared to the index, which is beta, etc., right? You can take different financial ratios. The idea here is to showcase that how we can put a filter, right, before we start investing. Okay, so based on this, I just executed this cell, right? So this is a Jupyter cell where the only company that got filtered out was this one, right? Bajaj Finserv. Okay, so this will be our universe, right? So we keep things simple. We invest in only one company, right, for illustration, and that is going to be this Bajaj Finserv, right? Just a quick introduction to the Jupyter environment, right? So the environment I'm working in is called Jupyter Notebook, right? So this is like a really handy tool for research, where you would have already realized I have got some text, I have got some pictures, I have got some code, right? So this is like how you embed everything in one place and you can conduct your research, right? So this remains one of the favorites with all the quants and data scientists for conducting research, right? And this thing that you see is basically called a cell, right? This is your input, this is your output. Okay, but not going too much into the code. I hope you got the intuition. What we did was that, okay, we said the profit growth has to be greater than 30% and our P by E ratio has to be less than 40, right? And we got this company. Okay, and this will be our target universe for developing the strategy, right? Second alpha, right? So first alpha we got by superior security selection. Second one, we will use the RSI indicator. Okay, and this is one of the more popular indicators with all the traders. So I hope all of you know this. If you don't know, no worries, we'll discuss. So basically RSI number ranges from 0 to 100, right? And it indicates the strength in the price, right? So if the number is higher on the higher side, right, then it indicates, okay, so the strength in the price is likely to sustain. if the number is lower, then we say, okay, even though the price might be going up, it might not go up for very long, right? It is sort of losing steam, okay? And a lot of people use this indicator in different ways, right? So that's one of the beauty, that how very simple indicators are used by different people in different ways, right? So some traders will tell you that you use the 80-20, RSI. So if RSI is 80, that means the security is overbought. If it's 20, then it's oversold. I tend to use it in a different way. So I just look at this number, right? So if the RSI is high, then I say that, okay, it's got strength in it. The trend is likely to continue, right? And the way we develop this strategy is like this, right? So if we take any, let's just actually, take some real data. Okay, so just give me a moment. All right. So here I've got similar stock, right? If you try to analyze it visually, right? So I've got the RSI indicator here at the bottom. Okay. Now this price is basically this level is 60 RSI, right? Wherever you see this green cloud, okay, is where the RSI is greater than 60. Wherever you see this red cloud, the RSI is less than 60. Okay. Now let's see, like, if we can predict the upcoming price movement based on RSI. So we can see that as RSI dips below 60, the price sort of loses steam. Then same thing happens here, then here, and then again you see this is the big crash that happened, the big coronavirus crash that happened, right? So we can see that basically this this big move, right, was well predicted by RSI in this case, right? We would have, the RSI would have dipped below 60 at this place. So, and on the other side, whenever there is like a uptrend, right? Whenever the market, gains some value, then at that point RSI is sort of above 60, right? So wherever you see the green cloud, we see like, an uptick. Okay, so over here also we can see that when the recovery started, it was well caught, right? So we will use this knowledge to actually and the same thing is actually represented here. So basically the red is RSI below a certain value, green is basically when RSI is above a certain, right? So we will try to use this to choose our entry and exit points. Okay. So let's come to the rules of the strategy, right? And they are fairly simple. So what is our rule? It's as simple as this, right? Rule is buy and stay invested if RSI value is greater than 60, else exit, right? So as we are developing, say, like a long only strategy, right? Our main aim is to, we are not going short at all. So we are just going to be long all the time, right? So we will stay invested if the RSI is greater than 60, else we will exit. Okay, simple rule, right? Most traders will get this one, like fairly easy rule, right? Then let's move on to basically codify these rules and backtest it, right? So the first thing that I do is that I have to define like the time period, okay, the backtesting window in which I want to backtest. Okay, so I will basically take from 1st January 2020, before the COVID crash, and up till the mid-January this year, right? Why have I chosen this time frame? Because in this time frame we saw almost all the three phases, right? So basically, first we had the great fall, right? When the markets kind of collapsed almost 30%. Then we saw a little bit of consolidation, and then finally we saw recovery, right? So this phase captured all the three sort of regimes in the market, and that's why I have chosen this, right? And in the next cell, we are fetching the required data from the Yahoo Finance, right? Yahoo Finance has this, it's a wonderful free place where you can get your like historical data. So for example, you can see that if you go to historical data, you can download this thing as a CSV file, or you can directly fetch it into your Jupyter notebook or your Python environment using YF. YF stands for Yahoo Finance Library. Okay, and it's got a download function where I just tell it the ticker. So this is the ticker for Bajaj Finance. Start and end dates remain from here, correct? And we are just fetching the close prices. So adjusted close. Why are we taking adjusted close? Because it is already adjusted for all the corporate actions, right? So let's just fetch some data from the internet, right? So there you go, right? So we have got our data for the required time frame. So we have got the stock price from 1st of January 2020 all the way up to almost 14th of Jan this year, right? 15th would have been like a weekend, so we don't have data for that day. But in a jiffy, we have got some data from an API, right, within our Jupyter notebook. Okay, and that data is stored in something called as DF, which stands for data frame, right? Simple. Next thing is that we need to compute the RSI, right, for all those days. Okay, and for that I'm using a library called TLib, which stands for Technical Analysis Library, which has got this RSI function. So all I need to do is to put that price in it, and it will throw out basically RSI values for those days, right? So before we just had the stock price, correct? Now we have computed RSI using this function. Okay. So once we have the RSI, right, we need to actually codify the rules. Okay. So how do we do that? So basically we create a variable in Python which we call RSI threshold, and we keep it at 60, right? And then we create position using a function, right, such that wherever this RSI is greater than threshold value, right, wherever RSI is greater than 60, our position becomes 1, and 1 stands for that we are long that position, right? We have bought that stock. In all other cases, it will be 0, which means we are flat. We don't have any position, right? Very simple. In just 2 lines, I have been able to just code my entry-exit rules, right? So once I have done that, okay, which is right here, okay, I put threshold as 60, np.where RSI exceeds 60, right? Let's see how it looks. So I've got a new column called position right over here, okay, and it has a value of 0 whenever the RSI is below 60. Okay, that's what we thought, right? As you can see, so on this date 65, so it became 1. On all other days, we don't have any buying signal, right? So this is, in a way, you are generating signal, right? Which day you have to buy and so on, right? So for example, here the RSI went above 60, it remained above 60 for a while, so we were long all those days, right? And so on, right? So we are working with daily data here. If the 1 is continuing, that means we are staying in the position, and then we exit whenever the RSI drops below 60, correct? Now, once we have created positions, we want to make sure that we have done it properly, right? So for that, we will use the advanced visualization features in Python, right? So let me just set the zoom correct so that we can see the, yeah, all right. Okay, so what do we have here? So we have RSI on this axis, correct? And we have got our position on this axis. So we have got double y-axis, right? So on the right side here, we have got the position. And position can only be 1 or 0, correct? Because either we can be long the stock or we will be flat, right? Now, as we move forward, we just follow this thing. So you see, whenever this RSI is less than 60, our position is 0. As soon as it reaches 60, right, we go long. If it dips below again, we exit again, and so on, right? So for example, here it dipped below 60, RSI dipped below 60, our position is 0, right? We were flat, we didn't have any position. Again, at this point we enter, correct? And this was RSI, so but actual positions will be taken at the stock price level, correct? So the same positions when imposed on the stock price over here, correct, you can see that the kind of signals it has generated. So just before the great fall, right, RSI went below, so we went flat, correct? We didn't have any position. Then we had some position for a while, and whenever RSI went above 60, we were sort of long, right? Again, we didn't have any position here, but at this point, we again went long, right? And we sort of got to ride this recovery a little bit, right? So this is the basic idea, like how we can try to avoid the big falls, but at the same time try to ride the phases where the market is trending upwards, right? Cool. So the next thing again is that we need to calculate the returns. Okay, so again I have got basically just the percentage change formula, right? You can calculate the returns for both the buy and hold case as well as the strategy. Then we can compute the equity. So equity is basically if I invested $1, right, then how much it would become, right? And it will be more clear once we start plotting it, right? So let's just plot it, and this thing should make more sense. So basically now we are looking at the performance of the two strategies, right? All right, so there we go. So what I have over here is the equities. Okay, the blue line is our strategy, the RSI strategy, and the orange line is just if you would have just bought the stock and left it, correct? Now you can clearly see that of course our strategy is beating the buy and hold strategy, right? What would have happened if we invested $1 in each of them? By 1st of January, our buy and hold case, which is the orange one, would have resulted in a loss of roughly 8-9%, right? Because our $1 became 0.9 cents, right? Whereas if we invested in this RSI strategy, we would have done fairly well, right? We would have made 20% in 1 year, right? Doing this. And in addition, we saved ourselves from this big, sort of drawdown that we had, right? So the markets tanked. A lot of people would have panicked over here and got out, right? So because a lot of trading happens on emotions. So if someone was following a discretionary approach, they might have panicked and gotten out, and they would have failed to, then ride this recovery, right? But this one, the blue line is much more stable, I would say, and rides the recovery well, right? And here is basically our return that we have printed. So return from passive buy and hold approach is minus 8.2%. As you can see, our $1 became 0.9 almost. And from the RSI strategy, it is 20.5%, right? So there's a great difference. It's almost 30% difference, right? So this is a sort of edge, you can get. But we took RSI threshold as 60. Is this the best threshold, right? We don't know. That is something we need to test on the data, and we see if there is a value of RSI, which can give us better results, right? So what if we change this threshold value to 50? Okay, instead of 60, we change the strategy parameter, which is this RSI threshold, to 60, correct? And that is a common technique, a very basic technique. If you remember over here, instead of just putting 60 over here as a number, I created a variable so that later on I can just play around with this number, right? So I can put 50, I can put 40, whatever, right? So the same code sort of I have below, but at this time I have changed the strategy parameter to 50, right? So again, we have the same sort of data, right? But this time the positions are generated based on 50 RSI. So anytime RSI is greater than 50, we are sort of long. Anytime it is less than 50, we are flat, right? We don't have any position. Now, Next thing again, so we will just repeat the whole drill to visualize how it would have fared. So let me just execute the codes. Uh, right, so there we go. Right, so this is the RSI thing, right? Anytime it's below 50, we don't have a position. Correct. If you can see it better using these lines, you can see that this is the 51, right? So below that we are flat, and anytime we exceed 50, our position becomes 1. Otherwise, it's 0. Correct. These are the new rules, sort of. Let's see how it fared. Well, was it able to capture the moves in the price? Yes, I think it did a fairly better job. It sort of avoided the big fall. It sort of captured this up move and so on. Right now, quant-wise, I shouldn't actually depend on these sort of visualizations, right? Too much, because for me, numbers are more important, right? All this information is captured in numbers, but just to showcase like what is the alpha that we are trying to capture, it is always good to have some visualization, right? Now let us just look at the returns. And this time when we put RSI threshold to 50, our buy and hold would remain the same, right? Because it's just buying and leaving the stock. But our returns from RSI strategy with 50 as our threshold are roughly 65%, right? And that is not bad, right? We are almost 73% above the buy and hold approach, correct? So this is basically we have generated some excess profits above our buy and hold approach while avoiding all the downside bumps, right? So we avoided this, right? And this is very important, correct? So when we look at return, we have to look at both, right? We can't just look at returns. We need to look at the risk side as well. And that is why I chose a backtesting window in which I also had this great fall of coronavirus, and then I also had the recovery, and I also had the consolidation phase, right? So I hope this has given you like a good, intro to how we can utilize data, right? Now, a lot of people who are not, comfortable with the Python code. So basically, don't worry too much about it. I hope this is not something that you can get in a day or two, right? This takes little bit of practice, and for that we have shared some resources with you already, hopefully on email, where you can learn those skills, right? It takes little bit of time and effort, right? But then you can have some good advanced level analytics capability, right? And this was only one stop, right? There are thousands of instruments that you can analyze. RSI is only one indicator. There are thousands of indicators like that, right? People even create their own indicators. Okay. So there are so many types of alphas that are out there to be exploited, right? And it can actually lead to some good outperformance. Okay. Now, thing is, how can we make this better, right? How can we make this better, right? There is always scope, because see, these returns that we have calculated, they don't account for number one, brokerage, right? Although we don't have so many trades in this, but if you are developing a trading strategy, you would want to make it more realistic whenever you are backtesting, right? And that would involve you to actually include costs like brokerage and also slippage, right? So slippage is when you are trying to execute an order and you fail to get the price you are trying to execute, and you have to get a little worse price. So the amount that you lose trying to do that is the slippage cost, right? So that is basically that we can include here, right? But what is the conclusion, right? So the conclusion that we got from this is that simple rules-based approach, right? We didn't do any rocket science here. All we did was, if RSI is greater than a value, we buy. If RSI is below a value, we get flat, right? We square off our position. That's all, correct? Simple strategy can actually, be used. You can have a simple rule-based approach. You can boost your return significantly, as you can see, right? You can also cut down on large losses and drawdowns, as we can see over here, right? It doesn't look much over here, but you can see that actually the price had a massive fall, right? So a lot of people would have panicked at that point. We don't want such heart attacks, right? No one likes emotional discomfort, right? And as we see that one of the advantages of quant trading is that it saves us from all that if we do our work properly, right? But today we have seen how we can actually sort of design a simple strategy and backtest it on past data. Then we saw that how we combined multiple alphas, right? So I just took some fundamental data, right, to create a screener, right? Then I used RSI, right? You can use MACD if you are more comfortable. There are n number of indicators out there, or you can choose not to use any indicator, right? You can exploit some knowledge such as, say, even the timing, right? So for example, you can say that large amount of selling comes around 1:30 p.m. or something like that, right? If you observe different markets, there are those patterns that you can learn to exploit, right? Here we just took an example of RSI, as most people would be aware of what it is, right? Being trader. Then most important point then is that data can be utilized to our advantage to validate and optimize a strategy, right? This is a very basic level of optimization, right? Because I had to keep it simple. So from 60 we made it 50, right? But there are ways in which you can optimize multiple parameters, right? And optimizing doesn't mean that you're going to overfit it, because the steps of paper trading and forward testing are yet to be done, correct? At this point we are just seeing, right, if we can tweak the parameters here and there and gain some advantage. So that's what we did, correct? Right. So data can be utilized to our advantage to both validate and optimize the strategy. We saw an example of that. Final conclusion is that profitable doesn't always have to be complicated, right? So sometimes there are very simple things, right, that can make you money, but if you are able to analyze them better, correct? So it all depends on your analytical skills, your knowledge of how you can work with data, right, to create some rules, right, that can sort of give you like a system, okay, which incorporates both profitability as well as risk management. Okay, so the reason I didn't focus a lot on the risk over here is because the risk management is sort of built in to this strategy, correct? Because as soon as we see that the RSI is weakening, we sort of exited it, correct? We just squared off all our positions, so our downside got really limited. Okay, but this is a simple strategy. If you have a more complex strategy, maybe you can have different kinds of limits and stop losses and all that, right? Okay, so what are the next steps, right? So as I mentioned, two of the things, first of all, the brokerage and the slippage costs are not included in this, right? So to make it more realistic, we should actually include those, right? Then we can extend this idea to multiple stocks, right? So here it was just one stock, okay? But generally, one of the advantages of algo trading is that you can scale up your operations, right? You don't have to look for stocks. The algo will actually scan for these conditions, right, on a set of stocks, right? Wherever this condition is fulfilled, an order will be sent to the exchange, correct? So really we can scale up, right? But due to the scope of the session today, we just kept it simple. Next thing is we have to paper trade the strategy, right? Something which has worked in the past does not necessarily work now, right? Or in near future, right? It might or it might not, right? We need to test it. So for that, what we have to do is either we paper trade the strategy, where we don't actually use real money. We can create a demo account, right, or a simulator type setup, where we can trade with dummy money, right, and see if we are still generating those profitability and risk profiles that the strategy promised us during backtesting, right? Uh, then detailed analytics, right? So here we are just looking at the final profit number, but actually when you sort of backtest a strategy, you get a plethora of information, about the risk characteristics of the strategy. You come to know about the Sharpe ratio, you need your Kalmar ratio, right? You need all those things to sort of get a more fuller picture. Okay, so that is something that we have not done. And finally, we need to have a setup for automatic execution, right? So we need to be able to connect to the broker and send the orders to the exchange, right, and receive confirmation and all that. Now, why I have not covered all this? Because you are going to see all this tomorrow, right? So tomorrow we are going to see something called as the Blue Shift platform, right? So what I want you guys to do is that if you can go to this link, which is just Google Blue Shift QuantInsti, and you will come to this page, right? Once you get here, you can create a free account by just signing up, right? And this is a great platform, as you are going to see tomorrow, that it gives you all those capabilities to execute your trade, paper trade, do different kind of research and analysis, right, all in a single. Yeah, so this is the link. Basically just Google Blue Shift QuantInsti, so you'll get there. And finally, I guess we are done. So I hope the whole session was useful to you in some sense. You got you learned something new that you didn't know, right? You also learned the importance of data, right, in analysis and in designing your strategy. We designed a simple strategy, but simple things can be powerful, right? So that was the message. And yeah, so that's it for today from my side as far as the presentation goes. I'll open this up for Q&A. So if you have any queries, do shoot them at us, and thank you very much. All right, Pawan, over to you.
Yes, thank you so much, Ashutosh. I mean, I thoroughly enjoyed it. I'm sure the audience must have too, right? And concepts like RSI and all of these things are really, really insightful. And it makes us understand that simplicity most of the times always pays. So it was a pleasure learning all these concepts today. And I'm even more excited about tomorrow as well, because tomorrow's speaker, Jay, is actually going to make us do hands-on all these things on the Blue Shift platform. So it's going to be really, really exciting tomorrow as well. Right. So what I'm going to do right now is, Ashutosh, I'll just pick up some questions from the Q&A which we have received, right? And we'll take them up one by one. So I'll just come up with the first question. It's by Arvind, who asks, how are you arriving at an RSI value of 60? I mean, do you have to try different permutations or combinations, or there is a benchmark which you have set?
All right, great question. So see, it is the same indicator. People use it in different ways, right? So I don't use it for overbought, oversold. What I use it for is to see the strength in price, right? That's what I wrote here, that RSI shows the strength in price. So a higher value would signify that there's more strength in the price, right? And if there's strength in the price, I just want to get it, really early, around 50, 60. I don't want to wait till 80, right? Because after 80, it might start coming down, right? Because 100 is the limit. So if I have to ride a move, I number one want more strength in the price, and secondly, I want to get it early. So 60 is about a value that many people use However, this changes from asset class to asset class. So what I would encourage you to is to try it yourself and see what value works in basically the asset class you are looking at.
Got it. Perfect. So the next question is from Varun. He asks, what is the duration of the ticket? Like, is it 5 minutes or 1 day or any duration of hours? What is the duration of the ticket for the analysis? And what is the recommended time to be used?
Right. So here we used like daily data, right? So this is all daily data, correct? From 1st of January. See, the time frame would depend on your requirement, right? So if you are a day trader who is trading for a living, correct, then you can use 5 minutes, 10 minutes, 1 hour, depending on what asset you are trading, correct? If you are someone who's looking to invest in an intelligent way or in a smart way using some knowledge, from technical analysis side, you can use daily data, right? So there is no fixed time frame. It depends on the use case, like what the trader is trying to do, correct? This strategy that we looked at was basically a smart investing strategy because we had less number of signals, correct? But it had the elements of trading in it as well because we use a technical indicator, right? So this is a great mix. So we use two kinds of alphas, fundamental and technical, right? But yeah, to answer your question, that time frame will depend on, you have to try, strategy on different time frames, and that's where the power of backtesting comes in, right? I would have taken 15-minute data, rest of the code would have remained the same, correct? And I would still know if the thing is working or not, right?
Perfect. So it basically depends upon the person's requirement and what kind of situation he is in. I mean, if he's a day trader, then of course he'll have to consider a shorter time frame. And if he's like trading, uh, just trading, then might be also comfortable with a day's data also. So I think that answers Varun's question. I have the next one from Dipesh. He asks, we are getting RSI at the end of the day here. So if RSI goes below 60 by the end of the day and it rises again, then will our position be there or not?
So that's a great question. See, when we use this close data, right? So how is this close price calculated? So it is basically like a weighted average of the last 30 minutes, at least in India, right? So there's a certain mechanism using which this price is calculated, right? It is very different from the last traded price. Okay. Similarly, when we calculate RSI, right, using these prices, what we are assuming is that that is the RSI right at the end of the day, right, near the closing. Okay. And we generate a signal there and then before the market closes, right? So to answer your question, it is end of day, right?
Perfect. So the next one is from Dhruv. If there are so many ones, then won't the algo keep on buying?
No, because see, what we have done over here is what is called vectorized backtesting, right? So the whole idea is if there's a one over here, right, on this day RSI is above 65, a long signal is generated. So we buy basically at this closing price, right? Next day at the end of the market, because it is below 60, we exit at this price, right? And the difference is what we have earned, right? And in this case, we lost money because from 9888 it became 9634 and we lost little bit of money, correct? And when we have like signals like this 11111, that means we actually suppose we got in at this price, we bought at 5899. Next day, because our condition was fulfilled, we didn't do anything, we stayed long. Then again we stayed long, etc., and then we exited at 5890. So this was another trade, correct? So like that, that is the approach we have.
Got it. Then the next one is by Yash. I think it's on similar lines. We should hold at RSI of above 60. But if you sell at RSI of 60, isn't the
Sorry,
net earning for
1 second, give me a moment. Hello.
yeah, Ashutosh.
Yeah, can you repeat the question?
Yeah, of course. So Yash is asking, we should hold at RSI of above 60, but if you sell at RSI above 60, but if you sell at RSI of 60, isn't the net earning zero?
No. Because earning depends on the price, correct?
Ashutosh, your voice has we have lost your voice. So
Okay, is it better now?
yeah, it's better now.
Right. So you see that RSI is not determining our PNL. Our PNL is being determined by stock price, correct? So RSI may be 48 here. The price was quite high at this point, right? So look at these 2 points. RSI has similar values, right? But the price has gone from here to here, correct? So PNL is calculated on the stock price, not on the RSI. RSI just tells us when to get in and when to get out.
Okay. So this question has come up a lot regarding the additional charges which should be included along with the trade. So I'll just take one by Mehtab. He mentions, or rather asks, so what do you adjust for taxes and other charges in the strategy?
No, in this strategy, I have not, included taxes, but taxes actually differ from jurisdiction to jurisdiction, right? So it won't make sense for me to include Indian taxes and all. But see, any time you are like making, say, you invest 100,000 rupees, you get back 165,000, correct? So then you pay whatever the going tax rate is according to your jurisdiction, right? So that is something that is not included here, but you can definitely include that, right? So you can also create a backtesting where you can include for brokerage, for slippage, for taxes, etc., etc. Right? So all the charges, even if you deflate all those charges from this number, it is still quite high, right? So yeah, I mean, you can do that.
Okay. So Anmol asks, he really liked the strategy, right? And he mentions that as we know, RSI works well in trending market, but it's not good in sideways, because of which there will be a lot of false signals. How can we avoid those false signals affecting the strategy?
Okay, so that's a great question. But see, the thing is that no strategy is like super perfect, right? So if you do some study, of some research papers, etc., you find out that momentum is one of the biggest, alpha factors, correct? And yeah, you are right. So for example, over here, we were generating some signals that were basically just in out, right? So they would have cost us some money. Having said that, given that this is a 1 year time frame, those 5 odd signals were okay, right? So this strategy, as you correctly mentioned, captures momentum, right? This is not actually made for a sideways market, correct? Now, if you were trading on an intraday basis, then this thing would look, intraday movements would look very different from daily movements, correct? The whole picture changes. So like a 50-point move, can be captured by RSI if you're using intraday 5-10 minute data or something, correct? So it depends on the perspective. Now, having said that, no strategy is perfect. This is not a perfect strategy, right? By all means. And RSI may not be the best indicator out there. But the whole idea was that how was to showcase how you can, sort of get benefited from whatever alpha factor right? But everything has to be researched on data, correct? So this point is the most important, that not for a moment will I say that this is the holy grail strategy or anything. It is one of the strategies which happens to work on this asset, right? We always go back to the data, right? As quants, as data driven people, we always go back to the data, and we we validate everything on data, right? So yeah, that's the point.
Okay, got it. One a bit, it's related to Jupyter notebook. Someone is
Yes.
asking, Chetan is asking, the way you visualize the data on Jupyter notebook, which particular package did you use? Was it matplotlib?
So no, for this one I have used Plotly, but you can also use Matplotlib. They are both good. I use Plotly because this is kind of cool because I can basically kind of say zoom in a particular section if I'm interested, right? So for example, uh, right? So if I just want to focus on the recovery phase after coronavirus, I can just do this and I can like do a more granular analysis, right? Point is that here we don't have intraday data, we have daily data. So all I am seeing here is the basically the date, right? However, if we had intraday data, I say minute level data, right? So if I wanted to look at the bigger picture, then I would just look at it like this. If I wanted to dig down, I would just zoom in. I will have the even the minute levels over here, correct? So I just prefer this, but you can definitely go with Matplotlib. So that's the beauty of Python, right? You have so many brilliant packages.
Understood. Great. So I think it answers this question. We have next one from Faye. He asks, can you automate the trading part? Place an order automatically after a particular condition is satisfied. I believe yes, right?
Yes. That's the whole point, right, of automated algorithmic trading. So what I would say is my colleague Jay will probably cover it in great detail tomorrow, right? So this point of automatic execution, how you can connect with a broker and launch your trades into the exchange will be covered tomorrow in detail. But what we looked at today was basically like my slate or my scratch board, right? How I do it's like my laboratory where you can get in some data, get some idea, and try to validate it, test it, do some trial error, correct? Because developing profitable strategies would take time, right? It's not like a like very quick a job, right? You have to spend some good amount of time and trial error. So for that, Jupyter Notebook is a great place, right? That's why it's one of the favorites among quants and researchers.
Perfect. All right. So the next one is from Devanshu. He asks, you have assumed the same stock universe. What if the stock is no longer meeting your criterion?
So then I won't trade it, right? If it's not meeting my criteria, I will not trade it. Correct. So that's one of the filters you have to put because there are so many instruments out there, right? There are thousands of instruments that trade on exchanges. Um, if by working hard you develop a proprietary system, correct, on which you base your trades, and I assume that you will put a lot of work in developing it, then you will stick to it. If a certain security doesn't qualify, then you will not trade it.
Perfect. So there is the next one in how effective is time series analysis in stock price prediction? This is by Lakshmi.
Oh, that's a great question. So time series analysis is really important, right? So see, basically we are working with time series data here. If that is, if someone missed it, then we were working with time series data throughout here. Uh, and what time series analysis helps us to do is to actually identify those patterns, right? We can identify seasonal things. We can identify what is happening on a daily basis. We can identify the month effects, right? So yes, it can be used in very very creative ways also as far as developing a strategy is concerned. I won't go into too much technical detail, otherwise it would scare a lot of people away. But to answer your question, yes, that is important. And increasingly, the machine learning approach to time series analysis is also getting popular. So apart from time series models, LSTM models from machine learning are also used, right? So that's just FYI, right? But yeah, to answer your questions, yes, it can give you some advantage if you do some research and develop a model.
Understood. Perfect. All right. So Ashutosh, what I'll do is I'll take up the last two questions since we have time constraints, right? And just to let you all know, now whatever questions we haven't answered, just like today, we'll be getting back to you guys via an email. answering all your questions. So do not worry about it if your questions are not getting answered right now. So Ashutosh, I'll just take up the last two questions and then we'll conclude the session. Right.
Sure.
And so the next one is by Subhajit. Can we see application of a solver library to get the optimal RSI threshold, or is application to find that optimal value is a good approach for algo trading?
See, so optimization again is basically a double-edged sword. You don't want to over-optimize anything, right? Because if you over-optimize, then it might not generalize very well, correct? So that is something that you have to be really cautious about. But yeah, you can definitely use, there's a package called SciPy, right, which has got the solver facility where you can actually optimize, any variable. So yeah, you can do that, but then again, then you'll have to see if it's going to generalize well or not, right? You don't want to over optimize.
Perfect. So there's the last question. I believe the name is anonymous, but it's a good question, I feel. Can we also codify things like candlestick patterns, which are very important in technical analysis of price action?
Yeah, definitely. So see, basically one of the core principles of many algo trading firms is that everything can be codified, right? Anything which has got logic can be codified. Okay. Now the question is how difficult the logic is, right? What level of expertise will it take for you to actually convert it into a code? Okay. Technical analysis patterns can definitely be codified. So a lot of people actually also use, for example, computer vision and machine learning to actually identify patterns, right? That can be done. But again, so once you do that, next point is basically, is it useful? Is it worth the effort? Correct? Are there more easier, like lower hanging fruits that you can pluck instead of going that route? Correct? So yeah, that is something that needs to be researched and tested.
Perfect. All right. Thank you so much, Ashutosh, for answering all the questions. And I still have a lot of them in front of me right now. But what we are going to do is uh, uh, we are just going to reply all of the remaining questions over an email, right? So before the session begins tomorrow, the third day, we'll be replying to all these questions, right? And just a side note to everyone, I would request that you sign up on blueshift.quantinsti.com because tomorrow is going to be more hands-on. Mr. Jay Parmar, he's an expert in backtesting and creating trading strategies. So I would humbly request everyone to sign up on blueshift.quantinsti.com. He has certain plans for you guys. So highly recommend you to sign up in advance so that you do not waste your valuable time tomorrow in the session, right? So that's there. And yeah, I'll be looking forward to seeing you guys tomorrow. And Ashutosh, just to let you know, we have got some wonderful feedback in the chat, right? So I think you have done a great job in explaining strategy creation and data analysis. Thank you so much for that, right?
All right. Thank you so much, Pawan. And thank you, everybody. I wish you all the very best in your respective journeys. So yeah, all the best. And hopefully we'll see you tomorrow again for another wonderful session with my colleague Jay Parmar. And till then, all the best and good night.
All right, great. Thank you so much, Ashutosh, and thank you so much, everyone, for attending. You will receive a feedback form right now once you exit the webinar. So please do fill it up so that we can cater to you guys accordingly. And we'll be looking forward to seeing you tomorrow. Yes, guys. Good night.